Hi, everybody. It's Michael Carlin, president of Henry and Horn Wealth Management. And we have a very important and special podcast video for you today. And I'm joined today by Phil McCollum. Phil's a partner at Henry and Horn, tax guru, expert. And for those of you that already know Phil from all of his work with PPP loans, new government regulations, those of you who've worked with him before will know that there isn't anyone better to help us understand the tax laws of today, how they're folding into the tax laws of 2021, and all the things that we need to do. Phil, thank you so much for taking time away at the end of the year to put this video together.
No, Michael, thanks for having me, and I appreciate your very kind and thoughtful words. And it's been quite the year for everybody. So we're looking forward to ending 2020 here in a strong note and a brand new, prosperous 2021 for everyone.
Yeah, and no one has spent more time researching all the tax laws. And so why don't we just spend a minute to break down where we're coming from. So the current tax environment right now is a bit more favorable than it had been. The Trump administration, reduced individual and corporate taxes. But why don't you just remind everybody about where we're at, and then we'll break down a little bit about where we're going.
Sure. Yeah. The last 3 years since the Trump tax law was passed in late 2017 have, in the years that you and I have been practicing, which is a little bit over 20 years, have been arguably the three lowest tax years that we've ever seen as far as tax rates for individuals and for businesses. I think of the child tax credit that increased significantly, and also even the income threshold there that increased. Bonus depreciation has been huge for a lot of businesses, large businesses, and even the Schedule C sole proprietorship. So it's been a very favorable tax environment that we've enjoyed, and hopefully we are able to keep it going into the future. But there's just a lot of really positive things. I can think of alternative minimum tax basically was eliminated for a lot of people. Only a few people get impacted by that. The healthcare insurance mandate, remember that penalty that would be imposed? Now we don't have to worry about that penalty on a tax return, and just a lot of really good things. And I think when you think the Trump administration was to get government out of the way. And one of the ways that we can do that is by having a very favorable tax environment to allow businesses to invest and people to keep more of their own money so that they can do what they want with it.
And it's interesting because I look at obviously everything from an economic, macroeconomic, microeconomic, and stock market perspective. And to your point, the stock market viewed all of those tax cuts extremely favorably. We saw, a significant move higher as a result. Once those tax laws were passed, it certainly was very accretive to many different areas in the market. And as we look forward, there is growing pessimism about what the new administration may be introducing for increased taxes. Now, on one hand, we have had significant deficit increases, not just with the COVID relief, which was significant. We had it on the Federal Reserve side, on the White House side, injecting some $10 trillion into the US economy from COVID relief. But above and beyond that, we've been operating in pretty significant deficit spending to go along with that. So it doesn't surprise me to see that there's like a call for increased taxes, for those people who want a little bit more fiscal discipline. And again, to kind of an effort to try to balance the government's budget a bit. But with all that, what are some of the things that you think we can be expecting the Biden administration to put forth?
So, you put it well. There's a different philosophy here as far as how we continue to grow the economy. And one of the ways really is to have government spend a lot of money, have the government spend a lot of money through various programs. So how do we fund those programs? And that's through and keep increasing tax rates. So Biden's tax proposal, and he's been, he started talking about his tax proposal back when he was a candidate for the nomination, not even the presidency, but back into the spring. And, we're looking at his proposal would be higher individual income tax rates. The phase out of itemized deductions would come back. I think one of the big things in the estate tax area that would go away is the step up in basis.
Right.
The capital gains tax of when you're over $1 million will be the highest individual income tax rate, which is 39.6%. And that's almost double
It's
what we're
crazy.
seeing now. Yeah.
But let's talk about the capital gains thing, because there's people that just don't always think about that. I mean, there are folks that are selling real estate for gains now that should be thinking about the timing of a potential tax increase, or maybe even selling their business. It could potentially be a big difference between selling your business now or your real estate now in this year and paying capital gains tax versus next year. I just don't think people are kind of dialing in like, oh, does capital gains tax affect me? For a lot of people, it will, particularly those with transactions. You got to be careful.
Right. And had an example today with a client. Yeah. He sold some land on an installment sale in the summertime, all capital gain. And there's going to be payments made on it the next couple of years. But the buyer's been able to find a loan that at a much lower interest rate. And he's like, you know what, I might just pay you off now.
Right.
And so the client said, should I consider taking that income into play this year? I'm like, with what's on the horizon. And like you said, Michael, we don't know exactly what's going to be out there. We do know this, that our tax rates aren't going to be any lower than they are currently. So I said, you ought to strongly consider it. Granted, you may have to write a check in April instead of April of 2022, but your savings could be incredibly significant when Biden gets sworn in, and if they're able to start changing the tax policy and increasing the taxes across all areas.
And you mentioned the basis step-up rule. And so I want to just make sure that the people who are tuning in and listening in know a little bit about what that is. And, again, if you die, at that person's death, then the cost basis, or the cost for which that they purchased that asset, gets stepped up or moved up to their date of death, which would allow those that are inheriting the asset to sell it after death without much or any gain in a lot of cases, which is a favorable tax strategy that many use. So there are cases where we have, clients who are a little bit older that have low cost basis stock, and we will tend not to sell them as aggressively because we are looking for that potential step up in basis. But there's a lot of potential challenges that could come from a planning perspective if we lose that step up in basis. Do you want to unpack that a little bit?
Sure. I mean, the example I like to use, Michael, is, someone bought IBM stock 30 years ago and they paid $30 a share, and they passed away this year. And I'm not sure what it's worth, but let's just say it's worth $100 a share. Yeah. That's $70 of appreciation. When the family or the member of the family inherits that from the deceased, their new tax basis is that $100. So if they sell it the next day, they're going to have very little gain or loss. Whereas with the loss of that step up in basis, their basis is still $30. So if they sell it at 100, they've got to pay tax on the $70 of gain. And the other part of that estate and gift tax reform that's being talked about is not only would the step up in basis be removed, but the exemption amounts that are currently at about $11.5 million a person, those would be reduced too. So you're talking about a double whammy here that's being discussed.
Have they talked about what that limit would be? Because you said we've been practicing 20 years. Listen, both of you and I have been practicing about a quarter of a decade. So, but when we were first starting, the estate limit was you had the ability to pass $1 million down, from one generation to the next. So what are they talking about, taking it down from 11 million to what?
What I've heard the most is basically it would be cut in half. That would go from 11.5 down to 5.75. So, because when it doubled, it went from 5.5 to 11. So basically they would reduce it back down to half of what it currently is, which is pretty significant because, 40% times 5.5 million, you're talking another $2+ million in estate taxes, in addition to that step up in basis loss that we would have.
Yeah, and there's so much that goes into it. There's a lot of planning that goes around when you're looking at things like estate tax from a life insurance perspective that you just have been able to ignore for most families, because not a lot of families are walking around with a total estate net worth greater than that 22 million or the 11 million plus $11 million number. But at 10 million, the rate of inclusion would grow, pretty significantly. It just again opens the door, and everyone should be prepared for what that means they need to be doing to prepare themselves and their estate for a Biden administration.
Mm-hmm. Right. I agree. And it is interesting to see that where these increases would go. People think about the estate and gift tax as being, well, it's the very wealthy people, the Rockefellers of the world, the Jeff Bezos of the world. Well, no, it's your family business that's been around for 30, 40 years that employs 200, 300 people in your community. It really has an impact on our neighbors that we work with each and every day and our clients.
Yeah, there are instances where I've seen upon passing where there's an estate tax that's been so large that it forces the hand of the family to start selling assets that they didn't necessarily want to sell, and they end up not getting good prices. It's a whole domino effect of things that I guess again a lot of folks don't take into consideration. Is there any notes on the corporate tax environment for the Biden administration yet? As things come out there that we need to be talking about, discussing, thinking about?
Sure. So he's talking about an increase there as well. I think it's 28%. And this is the corporate rate used to be higher. I think it was 35%. And if you may recall, it was graduated. It was 15%, then 25%, and then 35%. So they went to a flat 21% tax rate. And so this would be an increase. It wouldn't be like it used to be, but there'd still be a 28% tax across the board, depending upon, regardless of your level of taxable income. So I can't think of an area, Michael, where a tax isn't going to be increased. So thankfully, those rates aren't going back up to what they once were.
Yeah, because it was a matter really of U.S. competitiveness that there was prior to the Trump administration cutting the corporate tax rates. We had one of the more punitive corporate tax rates in the world to, after the cut, one of the most favorable. And, again, during the Trump administration, one of the things that we did not have is we didn't have a lot of companies that were threatening and or moving their corporate headquarters overseas. We weren't losing those jobs. I just wonder if that becomes part of this whole script again. I guess we're going to have to wait and see. One of the things, because we're Arizona based, I do want to spend a second unpacking it. Prop 208.
Yes.
Prop 208. You may have heard it. You may have had a question or two about it. And for those that don't know, Prop 208 was a tax that was voted on, that was passed, accepted by voters to increase the tax on ordinary income for single people making north of 250 or married filers greater than 500,000. It's a pretty significant tax increase, Phil. What do you think? What do you make of that whole Prop 208 as we sit here right now?
Sure. So, it's really interesting when you see legislature or, in this case, the prop that was proposed and where the initial money came from to support the cause. So
I know. Go ahead. Let's talk about it.
Yeah, it's interesting because when you start to talk about education, people, why wouldn't you want to support education? You're going to vote yes, and I think the momentum got behind the voting yes before the business community had a chance to really think about the impact it was going to cause. So with early voting, all of a sudden there's a lot of people that can just say, why wouldn't you got to vote yes for education? We all believe we need a stronger education system, not really understanding and knowing what the bill is or what the amendment was going to provide. And, when you read the details, are we sure that there's money that's going to be funded to education or that teachers actually going to receive an increase in pay? Right. So then when the business community starts to see, wow, we better get our people out there and start, lobbying to say no, it was a little too late. And Prop 208 passes and, it was close, but it wasn't that close.
It wasn't.
And I know it. Yeah.
So I looked at it and I thought, because in my mind, I was thinking, well, I wonder how many people are going to pick it up, recognize, and mobilize on it after the vote had transpired. And what I was surprised with was that, number one, Arizona went from one of the 10 best state income tax states to one of the 10 worst overnight. So that I thought was surprising. And it wasn't shortly thereafter that, there was an individual that I'm aware of. I'll leave it at that. He is leaving Arizona. He's leaving Arizona. He's going to Las Vegas, and he has a business that generates about $250 million in revenue. So he's got a lot of high paid employees. He's relocating to Nevada, where they have no state tax. That's just one that I know of. I don't know how many more like it are going to come. And I don't know whether or not Prop 208 is going to even stand. Because I guess there are efforts to get that repeal or the decision repeal or overturned.
Right, you're correct about the efforts. I know Governor Ducey's been meeting with some high net worth business groups to talk about, hey, is there a workaround here? And I've had conversations with clients where they're thinking the same thing that you mentioned, Michael, with the client you're working with. I might just leave the state. I might go to Florida. I might go to Texas, Nevada. And when you think of a tax increase, if let's say our rate had gone from 4.5% to 5%, we probably would still be one of the top 10 or 15 states from an overall tax perspective for businesses. But to go from 4.5% to 8% when you're over $500,000 for a married couple or $250,000 for a single person, overall that's effectively a 77% rate increase in tax to throw us into that bottom 10%. So it really has moved us from one end of the spectrum, the really strong business area, to a really poor place to have a business. So I think the governor is very concerned about that and the long-lasting impact that might have on the state.
And because the trickle-down effect is our real estate prices. So if you want to know how on an individual level this could impact you, Prop 208 could impact you if you own a home. We have all grown accustomed to kind of this new age of this new era of residential real estate here in Arizona. Like it always goes up and during good markets, Arizona goes up a heck of a lot more. We have people net moving here all the time. So it's what it does is it keeps the supply very tight in our residential real estate market, which supports home prices. You begin to wonder if this is a, one aspect that you start to lose in the residential real estate marketplace. So that's, again, something for us to consider, something for people and our clients to look at. So Phil, now that we've given them all kinds of doom and gloom about increased taxes and Prop 208, we hit them on federal and state. Let's talk about some of the things that people should be doing to help prepare themselves in 2021 and beyond. I mean, there's still hopefully a little bit of time left between when you're watching this and the end of the year, but what kind of things? Because I know you've got some ideas, I've got some ideas. Let's try to help people out.
Sure. So, one of the old tried and true methods as you get towards the year end is to take a look at your investment portfolio. Are there assets that you should recognize the gains, taking into account that the rates may go up next year? Is that a good idea? Are there losses that you should take because you may have some gains that you want to offset and balance your portfolio appropriately? Retirement plans, still always, regardless of the tax rate, always a good idea, because a tax deferred is potentially a tax never paid, right? I mean, if you put in money into a 401k, a SEP, some sort of defined benefit plan, and you don't pay tax on it, yes, more than likely you're gonna pay tax on it at the end when you start taking it out, but rates could be different. If you're retired, then your rate should be lower. So, always, regardless of the tax environment we're in, retirement plans are still a very solid way to look long-term and plan and save some current dollars. Get
the tax deductions during your high income years, and then as you can determine how much you want to take out and stagger your distributions later on in life, and it allows you to control your taxable income in retirement. That's always the best way to do it. Some of the things, for those business owners, what we encourage them to do is to take a look at the formula that you have in your 401k. Do you have the right formula? Is it the 401k? Do you have a safe harbor match? Do you have a standard match contribution? Do you have a profit sharing contribution? Is it age weighted? Is it cross tested? Look through the machinations. Do you have a defined benefit pension plan? Because there are things out there where you can get significant upfront pre-tax contributions to help drive down your income. But some of these things you're going to want to put in place earlier in the year rather than later, because there are some plans, for instance, like a simple IRA, if you don't make these determinations January 1st and you start your plan year contributing to a certain type of retirement plan, like a simple, you're stuck for the whole calendar year. So some of these planning tools, when it comes to retirement plans, for example, one, you got to hop on them early. So reach out to your advisors, reach out to your CPAs, your accountants, just to make sure that you have this addressed so that you understand, is there a more optimal plan type design strategy that I should be taking advantage of to help improve my overall tax situation?
And sometimes, Michael, those are all great ideas. And there's sometimes an individual may be limited
Right.
because of the plan document itself. Well, maybe you go ahead and maximize what you can, but there's also non-qualified deferred comp plans that could be looked at where, yes, you do not get a tax deduction on the front end, but it could be the proper investment for long-term, because then when the money comes out, you may pay less tax in the long run, a little more flexibility. You don't have the rigidity that's associated with, say, having a retirement plan that's managed where you have to have an annual 5,500 form,
Right.
ERISA rules applying, Department of Labor involved. That's something else to look at too. And then on the business front, one other idea that we've seen more lately, and I think we've seen it because companies have done so well lately, is the idea of a captive insurance plan.
Yeah.
And, briefly what those are is, you say you're a manufacturer and you have insurance to protect yourself against product going bad or employees at work that you may just have through your standard insurance company. There's the ability to set up a captive insurance company, and we have relationships with administrators that we deal with, very reputable administrators, where you could create this captive insurance company where you manage and address all your business risk. You might find a way to do something that there's an area in your business that you want to do something that isn't generally insurable.
Yeah, but it's a real insurable risk.
Exactly, yeah. That a company may be able to help you with that, and you create this captive insurance company that gets you current income tax deduction, but creates a long-term strategy for retirement and wealth transfer too with your family. Yeah. So yeah. Pretty neat idea that honestly, it sounds very
complicated.
Esoteric, complicated, and it can be, but with the right administrator involved, it can be done at a fairly cost-effective way, and very reputable companies too, because we definitely want to be aware of the dotting your I's and crossing your T's when you put a plan together like that. But that's something we've been talking about with our clients too.
Yeah, and it's interesting, Phil, because I think a lot of people, when they hear captive insurance agency, for those that have heard that before, particularly dating years back, they're thinking, oh, it's got to be this offshore entity. And maybe if you looked at it, or someone had a problem with one, there weren't real insurable risks. That world has changed. We're now, we're seeing them onshore, again, US based, which is, I think, key and critical, number one. Number two, they're being underwritten for real insurable risks. This is not like your father's captive insurance agency, which weren't run with the same quality rules and regulations. But again, reach out to your advisory team, reach out to your tax team, reach out to your people, so that you can, as you're going through the different concepts between retirement plan and all the different areas that are available, not qualified deferred comp, the captive is certainly a key and critical one to look at as well. Phil, we did a lot. We unpacked a lot about the tax law changes, and I guess couldn't have done any of it without you. Or if we could have, it wouldn't have been as good. You're awesome.
Oh, thank you, Michael. Enjoyed it. And Merry Christmas, Happy New Year to everyone. And, look forward to the next time we talk.
Excellent. Take care. Thank you, everyone. And let us know if you have any questions. Reach out to us at Henry and Horn. We're here all the time, working all the time, which is why we look so tired. Although, Phil, you look good.
Thank you.
Thank you so much. Take care, everyone. Bye-bye.
Bye.